In this presentation, we will record an advanced customer deposit. In other words, we're getting cash before we provide the good or service, in this case, the good of a guitar within QuickBooks Pro 2020, QuickBooks Desktop 2020. Here we are in our Get Great Guitars file. We currently have the open windows open. You can open the open windows by selecting the drop-down view window and go into the open windows list. We're going to be down here in the customers section. Now this is the second advanced payment we have recorded, so I won't go into as much detail, but this is the type of transaction that confuses most people that are new to QuickBooks or that haven't seen this type of transaction, because this is not the normal transaction. What is happening here is we're getting a payment from a customer before we actually do the work, and usually it goes the other way around. Most companies, we actually do work, such as if we did bookkeeping, we do the work, we invoice the client after we do the work, and then we get paid. Or we do the same thing at the same point in time, such as selling a guitar, where we sell the guitar and get paid at the same point in time, and therefore record a sales receipt. Not too often do we get paid before we do the work, unless we are in a particular type of industry or some particular type of transaction. Notice there's no arrows that basically do that in the flowchart. We don't see an arrow saying, hey, now we got paid and then we did the work. That would be like the sales receipt here, or the received payment happening before we have the invoice. And so what do we do in that type of situation? When would that type of situation happen? When would we get paid before we do work? Depends on the industry. Possibly if we're in a rental company, we rent, then we might want a deposit, a security deposit, which is a form of advance payment that we're going to have to either give back at the end, or that we will then record having earned in some way if we're not giving back the deposit. Or if we get some kind of industry, such as a service industry, where we provide a year's worth of service, such as magazines or computer services or something like that, and they advance pay us for the year's worth of service that we would then provide. Computer applications often work this way. Then we would be in an industry that basically sees this all the time and would have to deal with this as their normal business process. Most businesses, however, don't have that. We might, however, get a deposit early from time to time, possibly having an agreement that we will then say, hey, you pay us up front, and then we will basically do work in the future for that upfront payment. That would be fine. Or in our case, if there's a big inventory item that we want to sell to them and we don't have it on hand, we might say, you give us a deposit on it to make sure that you're going to complete the sale. Then we'll buy the materials or the inventory. Then we'll sell it to you and complete the sale. So we might want for example, 10% down payment or something like that. So how do we record that? Now, I'm going to go to the financial statements and walk through this real quickly once more time. We're going to go to the reports up top. We're going to go to the company and financial. We're going to go down to the balance sheet standard. So we're in the company financial balance sheet standard. We're going to change the dates up top in the customized report field. We're going to change the dates from 01/01/20 to 12/31/20, January through December 2020, and enter. So what would typically happen, what you would normally learn, and what should happen under normal accrual accounting, is the unearned revenue account, a liability type account, or you might call it deposits, but it would typically be a liability account would go up, and the other side would be cash would go up. If you're learning just financial accounting in just normal journal entry format, that's what would typically happen. There's a problem with that in QuickBooks, however, in that we would like to track this information by customer. By customer, we want a subsidiary report tracking this information. And we don't have any liability typically report tracking by customer. The thing that tracks by customer is tied to not a liability, but accounts receivable, because that's the account that usually deals with customers. Therefore, we would like to deal with it so that we can basically match up the invoice that we will create in the future to the sales receipt that we're going to have now, the money that we're receiving now. The way to do that is basically to do everything within a receivable account. So that's going to be a little bit different than you might learn in normal just journal entry accounting, because the journal entry accounting is only accounting for the parent accounts. Note that we can still be on an accrual basis and not be a problem by doing an adjusting entry at the end of the time period, which we will do, which will simply basically take it out of the receivable, increase in the receivable, and then post in the liability periodically. And that way we can logistically work in the system within QuickBooks to track the customers and the payments and receipts in the same fashion, even though it's in the reverse order as QuickBooks was designed to do, and still be reporting information on an accrual basis using the adjusting entry process at the end of the time period as we normally would. So what we're going to do then is, instead of create a liability account, we're going to create basically a negative receivable account for that one particular customer. Let's see what that would look like. This is very common, by the way. And again, if you haven't seen this before, it might be kind of unusual to you, but it's very common to see this. It works logistically in practice, and you can still adjust to the accrual basis. So that's why you want to be familiar with this. So what we're going to do is we're going to go basically up top. We're going to go reports drop down. We're going to go to the customers and receivables, and we want the customer balance detailed report. Customer balance detailed report. And then you'll notice that we've seen this before. We're gonna do this with the customer of String Music, but you can see right here we have in Anderson, we did this before where we had this prepayment. We had the prepayment of the $250 happen before we did the invoice. And it's okay now because now the difference between the two can tie out to that $275. However, before we entered the invoice, we had a negative receivable for this particular customer. The total receivables weren't negative, but we had a negative receivable for this particular customer, bringing down receivables in general, which isn't really proper. It should be increasing the liability, not decreasing a receivable. However, it works great logistically. Once it's all completed, it doesn't matter because you're back to the same point at that point in time. It's just a timing difference. But if there happens to be, as there will be with this one, we get to the end of the year and we want to report our financial statements on an accrual basis, technically we should then make an adjusting entry, which we will do. So we're going to do the same type of process here. We got a payment before we did the work. So I'm going to go back to the balance sheet or back to the home page. And you can think about this in any kind of prepayment that you would have, similar kind of situation, whether you're a renter and you deposit, you rent something and someone gives you a security deposit on that. Or if you're thinking that you're in an industry where you basically get paid before you do the work, same kind of idea would happen here. In our case, the scenario is someone came into our shop, String Music. They want a particular guitar. We can't give it to them at this point in time for whatever reason. We're going to say that's okay. We'll order it for you or do whatever we need to do. But in order for us to go through that hassle, we would like you to give us a down payment on the guitar, and then we will complete the process and invoice you. Therefore, what's happening is we're going to create the received payment before the invoice. When we create the received payment, it's going to be, usually this means, received payment means it's going to decrease the accounts receivable for a particular customer as well, String Music, which doesn't owe us any money, which means we're going to end up with a negative receivable, which is fine after we create the invoice. And then the other side is going to be going to undeposited funds, cash in essence going up. Then in the future, we'll do the reverse order. We will create an invoice or sales receipt, and then we'll apply out the credit to it. Let's do that now. We're going to go to the receive payments, and we're going to say that this is going to be from String Music. So I'm going to type in String Music. Do we have String Music? I don't think we have. This is a new customer. So new customer. So we want a down payment because they're a new customer. We don't totally trust them to give us this, we're going to order something. So we're going to say String Music. Our other customers, we wouldn't even need a down payment because we totally trust. But anyway, we're going to set this up. It's going to be a quick setup. There it is. And then we're going to say that we want $300 down payment in order for us to get this guitar prepped up and ready to go. The date of this is going to be the 21st. I'm going to go up one with a plus button on the keyboard and then tab through, and that's going to be it. You'll note that, and we could say cash this time instead of check, and note that there's no invoice down here. Typically, there would be an invoice that we would tie this to. Therefore, when we say save and close, because there's no invoice, it says, hey, a credit for the overpayment will remain on the customer's account. That's what we want, so we're going to say okay. What happens then if we go to the balance sheet? We can then see that the undeposited funds is increasing. So double clicking on that, undeposited funds, $300, double clicking there. There is our customer payment. Closing this back out, the other side then going to accounts receivable. And accounts receivable should be going down, as it is here. Double clicking this, we see accounts receivable going down. Now, again, it doesn't take accounts receivable down below 0, of course, but it does reduce receivables as opposed to increase in a liability. That's the thing that's a little bit different here than you will see if you look at financial accounting just entering journal entries. Why would we do that? Well, if we close this back out, we can then go to the customer balance detail report. And this is the reason, because this report supports the accounts receivable, and we want to track all the data related to payments and invoices in the same report. So if we go down the string music here, we see we have a negative balance. Again, the total balance isn't negative, but we have a negative balance to the string music. Now, accounts receivable means this is a report showing that people owe us money. So to have a negative balance in it seems like we owe them money, which we do. We owe them money or the guitar. And if we owe them money, you would think it wouldn't be an asset, but a liability, which it should be, technically. However, logistically, works very well here to put it in as a negative asset, because QuickBooks will be able to match up the payment and the invoice in a similar fashion as it would if we had the normal ordering for normal businesses, which would be invoice first, then payment. Here we got payment first, then invoice. That's fine. QuickBooks can match them up using the customer fields. If we then need to make the financial statements, as we will at the end of a time period, at the end of the month, then we can just simply do an adjusting entry for this, increasing the receivable, recording the liability just for the reporting purposes, and then reverse that journal entry out so that we can get back to this method. And this method works very well from a logistical standpoint.